Welcome to the Twomey Stock Market Report, and today is March 5th, Sunday, 2023. What a terrific market we're seeing out there. And this is going to serve as a couple of things. It's our weekly market update. I know it's your go-to video of the week, so let's get right to it. And I will start with, first of all, go to the TwomeyStocks.com webpage. There, you'll get our weekly newsletter. Just click on it. It'll deliver it right to your desktop, just like this. You get in there, we get all the information. We go through it in detail. All the market fundamentals as well as technicals that we're providing you. It's a really good analysis of the bigger macro and micro trends in the marketplace. And it's over 20 pages of detailed information. You can easily go to sign up for our trade tracker. We'll send you our trades, and you can also sign up for our trade alerts. All right, what's going on? We're going to go over a couple of key items. One of the things that I want to talk about is what happened this week. The Twomey Stock Market Report goes into detail of this, but basically the short story of this, the markets eked out a positive end with Thursday and Friday buying. A couple of things to transcribe. We had a weaker start in the beginning of the week as the new month unfolded. And in addition to that, we awaited 401k money to settle. We expected to see that Wednesday or Thursday kind of prop up the markets, but it happened Thursday and Friday. Very interesting. Also, what coincided Friday is that we got the latest PMI for February. And that came up, it's been negative below 50 for 3 consecutive months, and it came in at 50.6. Against the forecast of 50.5. ISM, the services sector, remained at around 55. So that is telling us two things. One is, manufacturing picked up from its lag. Could be seasonal, okay. But either way, it's still more in the positive than the negative. That's a good sign. Because if it stays below 50, you tend to get reduction of inventory build. You need less raw materials, you need less workers, and eventually you lay off people. And of course, we're not a manufacturing country anymore, or primary manufacturing. We do, softer type services. But with that said, it was a good number. It helped prop up the markets. But overall, what are we doing? We're seeing a conflict between two things. Short-term fixed income rates, or CDs, Treasury, they're offering near, whether it's 6 or 1 year, but the annual yield's roughly around 5%. It eked up to 5.1 last week at some point in time, and it was on a lot of people's lips. Everybody was saying, hey, why take any risk? Last year was so devastating for some. They said, hey, I'll take annual rate of 5% as a long term, park it my money there, and go to sleep at night, not without any worries. Well, that's certainly true for some long-term investors, as well as people, in an advanced age or nearing retirement. Why mess around with this market? So that's one issue. Also, too, anytime the 10-year yield seems to eclipse 4%, we seem to have the market pull back. Art Cashin from UBS, he was a longtime CNBC contributor. He's been around. He has seen many ups and downs, and he basically said, the yield above 4.1% will put pressure on the markets and cause stocks to retest its lows. But he added one thing. Don't forget, he said, don't underestimate that the Fed, since it's not buying up treasuries or mortgage-backed securities, MBS, as it did during COVID and the recessionary times, if you will, financial recession, they're actually unraveling their what they call balance sheet. So they're letting these notes expire, or they're trying to sell them off or retire them. Hence, since they're not a major buyer, we have to rely on either other countries, other people to buy these up, and a bulk of them, majority still are U.S. investors. But with that said, if that he also indicated Japan may get more hawkish and start pushing up on their interest rates. And if that is so, the yields on the 10-year Treasury will have to go up in order to attract additional investors. we'll see. I think that's kind of a little bit of a predictor, but we certainly want to keep an eye on that. Either way, we're having that competing factor as the economy slows. And in addition to that, what are we seeing? We're seeing a tremendous amount of pressure on stocks due to that because of the interest rate. So I'm going to kind of go through our market report and pick out some key items, right? We're going to go from the bottom up. The bullish bear CBOE equity put to call, it definitely rebounded, and we're on with Friday's advances, and we've kind of dropped below the bearish sentiment, and now we're approaching or in a more bullish sentiment. We'll see how that goes. We'll see if that's 401k money or an actual rebound in the marketplace. I look at the advanced decline chart for the New York Stock Exchange. It's kind of an overall indicator. And this is basically real time as close of Friday. But you can see the advances are now eclipsing the declines. All week it was fairly much flat until Thursday and Friday. So what happened? We came near the 50 EMA, and that may act as a line of defense. Hard to say. RSI is 55, so it's advancing a little bit. So it's telling us more stocks are rising in price. We're not in an overbought. We're nowhere near oversold. So it's a pretty good level to be at. We're starting to see the MACD here at the bottom flatten out. It is the fast has eclipsed near zero and going negative. The slowest MACD, not stochastic, is lagging, of course, because of the time frame, but there's still a gap, but it is a downward slope. So we're on the watch here. The 50 crossed above the 200 EMA, exponential moving average. So that's telling us that there's a golden cross or a bullish sentiment in the market. What I like to look at the New York Stock Exchange because there's a plethora of stocks in there, and it gives us a bigger basket, a bigger average. We're also seeing 61%. It's 63.5 as of this week that are trading above their moving average, 200-day moving average. Was a high of 71 a few weeks ago, so it definitely has retreated. But we're on the advance. How long this will play out, we're not sure. But if we look at the bear market rally of August, we did come to that 50, and then once we broke through it, we kept retreating, and then we flirted with it for from November to December, and then the markets took off the first of the year. So we either want to see it continue to advance, or at worst go sideways, which then we can make decisions on a tradable market. So overall, pretty good chart. Overall, the sentiment is improving slightly, and that's a good sign. If we look at the RSI, Relative Strength Index of all these stocks, it is not the end-all or be-all, but I like to look at that from a basket of, with my other technical indicators. We're seeing the SPY is at 52, the Diamond's at 50, and then the NASDAQ 55, and the Russell's 55. They're all in sell signals, those market indices. We're all in the Twomey sell signal. Whether it's short-term or long-term, hard to say. The short side of it, we're nowhere near overbought. They're 48, 51, 45, 45. So and they're also in buy signals, but it is deteriorating, and it prevented us from taking a position. We're going to monitor this into next week before we start taking some positions. We're going to continue with our other stock plays that are very favorable for us. So with that said, what is the RSI telling us? Well, it's kind of neutral. It could be up or down, yes, but we're not. What we walk away with this, where there's no pressure of overbought now for the major indices, and there's no pressure for oversold for the short side, or overbought for the short side. So we're going to see some movement one way or the other the next couple of weeks. That's all that's telling us. So we put it into our basket of all our other technical indicators. We're looking at this technically now, and it's telling us, hey, some decisions need to be made, positions can be had, but we're not eclipsing any radical change as of today. So we look at the market sector. We like to see where the money's flowing. I break this into further detail to look for a specific stock or stock sectors. But with that said, we filter this for 1 month, and we can see most is in red except for energy and industrials. The 6 month side, energy, industrial, materials, consumer staples, financials. Excuse me, this is not in order. Pardon me. Materials, financials, followed by energy and industrials, and then energy. So we're up there. Actually, it works out to be materials, then industrials, then financials, and then energy and information technology. So that's interesting. 6 months, we've seen a nice surge in IT. That's the Nasdaq's up 11% year to date in 2023. Pretty positive. That would have been nice if you got into that particular stock and rode that. We did sell off some of our technical sector stocks and took handsome profits as the market started to wane in February. Anyways, what is this telling us? There's really no place to hide right now. The last couple of days, the 5-day change, we've seen some increases here. Most going into materials, IT again, consumer discretionary. We'll see and then communications. We'll see how this all shakes out. But on the bottom line, long term, it's pretty negative. There's really no place to hide. So there's nothing screaming at us to invest right now that we're missing anything. And we'll go over the bond plays that we have, and then we'll also take some other look at what's going on. I also go into environmental analysis. What do I mean by that? That's like fiscal policy, government spending, taxation, global concerns. The pandemic aid for COVID is starting to expire in many areas. One is the boosted food stamp area benefits. That's set to cut, or did cut, March 1st. So that averages about $95 per family. So that, for those who qualify, that's a big bite in groceries. So as we all know, we've been going to the grocery market, things are just spiraled out of control. So that's going to be a big hit. Also, internet services is going away for that. That's a different, not necessarily COVID, but there was a federal broadband subsidy to keep internet within people's budget. It's expected to run out of funding next year unless it's renewed by Congress. So, there's a lot that those two areas may shake some short-term investing, right? Another thing that came out, I looked at the rate of jobs. 61% of U.S. companies said they plan to lay off employees in 2023 or pause hiring. That's pretty robust layoff, if you will, if that occurs. Credit card debts continues to grow. Car loan defaults, I look at that, it's hard to tell with that, if you go into my market report, I have a section there of what the experts are saying. Elon Musk came out and said, we're going to try to get a car for $25K out there by reducing costs, etc. Terrific. The average cost of a new car is $50,000, $49,999 if you look at Kelley Blue Book or the AAA. But the bottom line is, car loan defaults are increasing 6.2% over the course of January, or up 33.5% from a year ago. Yeah, I always look at those kind of items because that, and whether it's more secondary type loans. What do I mean by that? Mobile homes, cars, skidoos, boats, those kind of things. People will default or go file on payment of those before they will on their house or other items. So keep an eye on that. It may or may not become a reality. I'm also keeping an eye on this ESG if it becomes a reality, if the president vetoes that, because that may reignite that whole sector. Environmental plays may start to increase. So we'll keep an eye on that. We talked about PMI and ISM. We go into employment, layoffs, and lag factor. We're going to look at the charts now. Let's go with the SPY. Here's the SPY. We're looking at the daily SPY, and what do we see year from 2022? Wow. Well, let's go all the way back. Can we go back that far? February of 2022. There it is. We started the downturn from the height of January 2022. We had some tug and pull, every time it gets up to this upper trend track line, the Twomey trend track line, we seem to repel that. And then every time we get to the lower, so that's a pretty wide berth. But if you see lower lows, lower highs, lower lows, lower highs, lower lows. All right, that's the trend. Now, short term, what's happened? We've been able to break above this Twomey trend track line, upper trend, this year, 2023. It has flirted with it. Last week it was a little bit below that. This week it got repelled and is above that. So that's a good sign if that can hold serve. But if you look at February, if there's the February time frame, from here to now, it's been lower highs, right? Come all the way down this short-term trend line, lower highs, right? And lower lows. So that's been the trend for February. Now we're getting a little bit of a bounce here. It hasn't really rebounded as high as we want. 2 days do not make a trend. We've got some good volume there, so we're on the watch. Is that 401k money or is that an actual trend change? We're above a couple of key indicators from a technical perspective. The 50 and the 200 are flat right about at the same time. We closed above that. We closed above the 9, and we closed above the 14 EMA. But the 9 is below the 14 EMA. We're still in a sell signal. We got quite a bit of work to do to get into a buy signal, and that's how these markets are running. We look at the diamonds, which is our proxy for the Dow Jones, and the Dow Jones. What did that do? Well, since January, it's really gone. Well, mid-December, it's kind of made this big sideways swath, right? Well, last week it did break below the lows of December. That may foretell the way the other sectors are going to go. If we go back to the SPY, right, that is nowhere near. It came back about 61% retracement from December lows, which is a pretty good pullback. But is this a breather, and will it do what the Dow did and head towards those December lows? That's what we're on the watch for. Now, the Dow has had less participation, been fairly flat. We think that is a foretell of where the other sectors are going, because money came into those beaten down sectors, the NASDAQ, the small caps, that sold off greatly last year, and people are looking at a bounce for that. That may be waning. Either way, the Dow is above the 50. It is, above the 200, the blue line here, EMA, exponential moving averages. If you go to our market report at the end, it has all the definitions of these. And then this is the 50 EMA. We're below that, so that's acting as resistance. We're above the 9 or above the 14, but we're also in a sell signal. We hit the sell signal back in the 21st. So all sectors, NASDAQ, diamonds, spot S&P, Russell 2000 are all at Twomey sell signals. So what does that tell us? We are getting lower lows, lower highs, and until that trend changes, we suspect either a sideways or negative market. Now, if we look at the MACD here is at below 0. It's -2. Once it's negative, it's a very negative sentiment. That means selling is overtaking buying. It is a longer term indicator. We pay a lot of attention to that because it can wallow at these lows for a long time. And look at this flatness from December all the way to now. Where's the MACD? It's been basically 0 all the way through. So, it takes a lot of momentum to break above or below. And then once it does, it takes a lot of momentum to change direction. If we look here, we ran from November to December pretty much positive as the market went up. But it took, a whole month to get, to break through that negative trend. So let's see, right now we're in neutral, right? Pretty much negative to neutral, right? The stochastics are faster oscillator. The green has moved above the red, and it is at 48. It's 0.9. It's at 50 something in the SPY. Anytime it gets above 50 and near 75, we see a short-term buying trend, right? If it gets above 75, that's a good sign that we should be taking a position, potentially short-term traders, right? If we're a short-term trader. If it's below 75 and then below 50. We know that selling is on the horizon, and it's a good time to get out. Short-term trading, right? This is a very short oscillator. It tells us what the trend change if we're getting a direction when we hit some of those key levels, all right? So what else we want to look at? We're going to use XLK for the NASDAQ, the technical sector, because we talked a lot about that earlier, about how it's up 11%. That, too, is pretty far off the December lows. What's going on there? Well, that is a little bit different. It is still in a sell signal, but it's getting near a buy signal, and we are above the 9 and 14 EMA. We're above the 50 as well as the 200. And lo and behold, what happened this week? This rise gave us a golden cross, telling us a pretty good sign. Now these are EMAs, not moving average, and that's telling us that we've got a good chance of potentially a further positive market. It's more bullish sign. It's not above all and end all, but it's something that alerts traders. I'm just going to go to the QQQs real quick. And again, exponential moving averages weighs more on the most recent data than the past. So yeah, that has not the Qs have not crossed positive. So, but that is still getting near a buy signal. All right. So we're on the watch there. Again, lower lows, lower highs, all of the month of February. So, we got a 0.5%, 50% pullback from the lows of December. It's telling us there is pressure on the market. We need more to develop, right? But we're going to see. We're going to see. And we're going to watch this very closely because we may be ready to take. So the first one would probably be the XLK that we take possession. Let's look at the IWM. Small caps is actually more favorable. We still have the 50. We still have the golden cross there. I'm going to write that in right here. And we certainly should see more bullish tendencies there. But, we've had lower lows and lower highs February. No surprise. We're getting near a buy signal there. And, we're going to keep. So those two of the sectors, those two areas are the ones that probably run into a buy signal first. And if we do, we'll alert subscribers. If we look at the 120-minute chart, which is shorter period, it gives us 4 legs of the day broken up versus just one daily bar. And we've looked here as, short term, did we, when we hit a low and then we got a next high, we didn't eclipse that last low. We didn't meet it again, and we went up and kind of got near the highs. We came back down, broke that most recent low, broke it again. Then we came back, raced above in the high. That's telling us, there's more breadth in the market. That has a buy signal. So for some who trade who are more not daily traders, but short-term traders, they would be making a buy here, and they would, it wouldn't be a bad entry at all. And then you certainly look at that. You could get in here, once you saw that crossover, you put your stop at 190. You probably got in around 189. So, you've got some positivity there in that trade. So short-term trades, you could go the 120-minute. More of that at a future date. Right now, we're just trying to give you a feel for the market. All right, a couple other things. Let's go to the TBT. That's 200% of the. Well, let's go with TLT first. That's the 20-year Treasury. We talked a lot about the 10-year. We used the 20 to ETF to trade the TLT. That has had certainly lower lows, lower highs all of February. It has been a cascading effect. We are getting now to a potential of exhaustion there. We've got a lot of positive buying the last couple of days, which is kind of odd because that's telling us yields are going to reverse and come down. We just went rapidly up to 4.1 on the 10-year, and then flirted with 4.1. 10-year and long term, you could get a CD for a 1-year CD now for 5%. So, it's interesting. I don't know. We had some really good volume in buying on that. So we're gonna, we gotta watch that as well. If it's a bump or if it's a return of yields coming down. If we trade the TBT, which is 200%, that's the inverse of TLT. So as yields go up, the TBT goes up. I believe it's the TBF, which is 1-to-1. This is the 200% that we trade. If it goes up $1, we'll get 2. If it goes down $1, we lose 2. And there's, if you read about, you know, the 200% type funds, there is a factor in there, decay factor, that really, is astronomical if you hold it for a long period of time. You don't necessarily, it's not a 1-to-1, because you end up losing more if it goes down. You have to be careful with that. But with that said, we did see quite a bit of sell-off as it reached up. It got to the last highs here, and that was high of 32.6, and we got up to 32.75. So we actually broke the high. We're still in a buy signal. It's still above, the 50 and the 200, which crossed positive some time ago. But what we haven't seen is this close, which closed at 30.83. Is below the 9 and the 14 EMA. And that tells us that there's some pressure, selling pressure ahead. We need to watch that. We didn't expect it to run off. We held it a couple of times last year. We got 48, 35% returns on that. We do not expect that to happen here. We do expect some type of leveling, and we did anticipate a more short-term trade. So our eyes are on that, and we're going to keep people alert about what's happening. So that's the market per se. There are some other stocks, and we're going to go right to our trade tracker. Let's see if we can pull that up here. All right, so like we said, we're at 5.73. We got into that 2.8 on the TBT. At this time, we did liquidate our indices. We didn't go short, and I'm going to show you that right now why. All right, so let's look at SH, which is the 1-to-1 short ETF of the S&P or SPY. Here we have a couple of things. One, the RSI is down to 48.8. It was a high of 56, not near overbought, and we're certainly not near oversold. We are at a buy signal, but it is narrowing here, and we had quite a bit of short-term drop of the stochastics with the fast down at below 50. That tells us directionally, short-term, there could be some further decline in this price. We're looking for a better entry, but this rapid decline the last 2 days, we want to wait to have that settle out a little bit. The chances are we are going to see this come back, and it may come back to the buy signal entry, and at that point we have some decisions to make. So we did not decide to get involved in that. Let's just look at the PSQ, which is short of the NASDAQ, and that is, again, getting closer to a sell signal, but it has not hit that. Same story. The volume did subside a little bit on Friday, but if you look here, short-term stochastic, where are we? Under 50. So that short-term direction has already started, that there is a chance. More selling on the short side, more buying on the long side. So we're holding off on indices right now. And if we look at the 120, what happened? We certainly got the sell signal, right? And this rapid decline from that sell signal. So if you're a short-term trader, you would have got in somewhere around here. And look at that. You only had 1 day to get out before you were back to where you bought in. So very rapid decline. That's why we're on a wait on any indice buys at this time. So we sold our longs. We preserved some profits there on the short-term basis, and that's where we're going to stay with that. Annaly Capital, that's our dividend, 16.85%. It's dropped a little bit, minus 7.5%, 7.7%. We're going to hold that for a little while and see if we can maintain at least a 10% yield if we are able to hold it all year long with the dividend play. But we're also not going to let it run and get out of control. If we look at stock-wise, NLY, what does that look like on the daily? Let's pull this back a little bit. Yeah, we did have a nice decline. We still have low volumes on up days since, February, lower lows, lower highs. It appears that we don't want to ride this all the way down. We kind of broke through the support line here. And that's telling us that we could be further selling ahead, and we may have to take some off this week. Uh, this is one that you could see here during that rapid downturn, it got hit pretty hard, right? But overall, before that, it was kind of flat for the year, April, May, June. So we're trying to get at least a 3-month run, but we may have eclipsed that at this point. And if we break this low, we're going to sell. You'll be getting a sell signal. I believe our stop is right in or around there, by the way. Yeah, 9.2. So we did adjust that. It was 9.6. All right, MGM, 21%. This thing is just taken off. Will it continue? We're up, keeps getting new highs. MGM, if we look at the daily, we've already eclipsed the highs of, we're right near, we haven't eclipsed it, pardon me, in February 2022. Actually, it was, it's getting near there. Is it exhausting? We thought it was, but we came back. We almost got a sell signal for the. We did sell our first third, but we managed to hold those other two, and it's now running off again. The fast MACD is crossing above the slow. Once that happens, it could go even higher. So we're not thinking about selling that just yet. Let's see. What else do we have? Borg Warner, same thing, 20.4%. Was it BWA? That is that consumer discretionary play as well as infrastructure, and that's just has beaten the last high in 2022. So is this a foretell of where other companies can go? Hard to say, but see this, it crossed above the the 50, crossed above the 200. It was a bullish event, technically, right? And what happened? It floundered for about a month or so, flirted with the 50, and then took off. So we're, in the back of our minds, one stock doesn't tell us the rest of the stocks, but, we've seen this 50 EMA cross above the 200 in a lot of the major indices. It's flirted with that 50 EMA, broke below that this week. Hard to say if we're going to be able to mimic these kind of stocks and take off, but that's what we're looking for. Because if we go back to the SPY on the daily, what happened? This is a busy chart, but the 50 and the 200, right? We broke below both those, came up, hit it as resistance, came down, created a new low, and all of a sudden we surpassed that. So is it a test or is it a breakout? That's what we, again, from a short-term technical perspective. Long-term, lower highs, lower lows, right? So we're preserving capital. That's the bottom line. All right. American Pipeline, that's our energy play. Instead of doing this, energy's been so volatile, but we know we want to be in it. So this is a dividend play, 8%, and we're up 12%. We've held that many positions over the past, year, and we've sold off it with spectacular gains, and as well as we've gotten the dividend now almost for a whole year. So that's pretty good. JP Morgan Equity, it's another dividend play, 11.9. That's down a couple percent. In addition to that, we've got the Enterprise, another energy pipeline, 7.7% is our dividend play, and that's up 3%. Our mutual funds, S&P has dropped down to 1.6. We did sell half of that a week or so ago. Technology funds were up 6.3. We did sell half of that for 2.6% gain. Short term, when we get into mutual funds, we really want to hold them, more than 3 months, preferably 6 or longer. That's what the market was predicting and telling us, and we followed suit, but we did want to preserve some capital with the rapid change in February. Small cap, 2.5%. We did sell half of that. And our more dividend play, pernicious core equity, that is holding at -1. We did sell at -3.5. Didn't work so well. Fixed income, CD, we bought a 6-month CD with an annual yield of just about 5%. So we're going to get 2.45% over the next 6 months. So we park some money there. And, if we choose to roll it over, we are looking at potentially higher rates. So we may end up with a better than a 4.9 something percent return. If we did roll it over in 6 months, we could end up with a nice yield there. All right. Above 5%. And then the I-Series bonds, November, we bought in at 6.89%. We expect that to re-rate in 6 months from November, and that's coming up soon. That's going to be an interesting tell. All right, that's it for the trade tracker. Some of our stocks, we went over the market report, and let's pull that up one more time. That's the Twomey Stock Market Report weekly for March 5th. You can go, hey, sign up for our trade alerts. Never miss a trade. 3 months, $39.95. Can't beat that. You can't even, go out and have dinner for that anymore. So there you get all our training videos. Shortly, we're going to be posting a video on how to set up your trading desk and all the technical indicators so you can be both a fundamental and technical trader. We do have some other training videos there that you can review at your leisure. And of course, then you get all your real-time alerts as soon as we make a trade. You hear about it. As soon as you make a sell, you hear about it. Anytime we change a stop, you hear about it right away. You're the first to hear. So that's the Twomey Stock Market Report. You can see us at the number 2, mestocks.com. Right? That's the number 2, mestocks.com. I'm James Twomey, and thank you. Have a great day.